Let's make a directional bet on the price of oil. So I'm looking at USO, which is United States Oil Fund. This tracks futures contracts on WTI crude oil. So basically, if this fund goes up, that means that the price of oil went up, and if the fund goes down, that means the price of oil had gone down. So this is a real basic supply and demand situation. If there's less oil available, then the price is going to be more expensive. And if there's a surplus of oil, then the price will become cheaper. And so last weekend, of course, as you probably know, US and Israel fired missiles at Iran, killing their leader, but Iran retaliated with some more missiles, shooting them all over the place, including the Strait of Hormuz at some tankers. So those oil tankers, a few of them got hit, and if there's less oil available, then this price will go up. And on top of that, we have insurance companies which had endorsements on tankers where tankers pay some extra money instead of a standard policy. They buy additional protection on their chance and risk of war. And so insurance companies had that clause triggered where they see, oh, now that area's in an actual war, we're going to go ahead and cancel that protection. So right now, those tankers are anchored on either side of that strait, going to wait it out and not pass through it, because if they get hit, then they're not going to be insured, because the insurance companies give them a few days notice that they're going to be dropping their insurance on that. And a few of them are saying if you want it back, you'll have to pay like 2 to 5 times what your premiums were to get that protection back in there. But, yeah, Iran tried to blockade the Strait of Hormuz with their navy, and then the U.S. started blowing up their ships. So if Iran successfully blockades the strait, then oil can't flow, and 1/5 of the world's oil and natural gas flows through that little strait. So if they do that, the price will increase. That's why I'm bullish on this fund, saying that oil, at least in the short term, will increase. And so that's why I've been doing put credit spreads, saying that I don't think it's going to go below this certain price. So you can see pre-market, we're up like 7%, almost around $88 for this fund. I already put in some credit spreads to queued up for the morning. So starting at the high of an $86 put with an $85 put, saying that I don't think it's going to drop below $86. Because if it does, then my contract to this put spread is going to start losing value. And you can see that this is only for a few days out. So market's going to open Monday, and on Wednesday, these contracts will expire. So I've just been doing these with $1 spread, starting with 86 to 85. And these other ones were queued up. So we have this one's 86, 85, 84, 83, 82, 81, 80, 79. So let's try for 78, 77. So you can click on trade options. Doing as soon as possible, because I think that this little spike in volatility and price will pretty quickly calm back down. So that's why we're doing this very short thesis here. Put credit spread 2 days away, March 4th on a Wednesday. And let's try this one. That bid-ask spread's pretty weird because one of them's negative, so I kind of doubt this one will execute. But those higher ones probably will. The one I just said is probably a little bit too low. But we'll see. These can always be canceled or adjusted with the limit price as the market opens. So we'll see. So several put credit spreads saying that we don't think that this fund representing oil is going to go below those prices, and then we can always close these back at a cheaper price. That's the goal. And so I'll be monitoring these closely for a quick turnaround and profit. So if you like this kind of content, please give me a like and subscribe, and I'll see you next time.